Welcome to Iron Financial, where we forge stronger portfolios by cutting through market weakness. Today, we're forging ahead, all right? But we're going deep into the often ignored plumbing of the oil and gas industry. We're going to stress test a company that's making some serious waves, WaterBridge Infrastructure. Now, the big question on everyone's mind is its financial foundation as solid as bedrock, or is the whole thing about to get washed out? Let's find out.
Right. Today, we're putting WaterBridge's latest earnings report under the microscope. And look, this company handles the dirty, the unglamorous, but the absolutely critical work of the energy sector. We're talking about managing the massive, and I mean massive amounts of produced water that come gushing out of the ground with every single barrel of oil. They just went public not too long ago, and their first full-year report is now on the table for all of us to see. So we're here to run the numbers, test the weak points, and really figure out if their financials are as solid as their pipelines, or if there's a catastrophic failure just waiting to happen.
Okay, let's dive right into this. You know, the first thing we always look for in any company, especially an industrial heavyweight like this one, is the raw power of its top-line engine. Seriously, before we even start talking about debt, profits, or any of the complexities, we just need to know one thing. Is this engine humming, or is it sputtering? And I gotta say, at first glance, WaterBridge's engine is absolutely roaring. We're talking about the sheer volume of their operations and the kind of revenue that it just pumps out.
Let's start with pure physical volume, because this number is just huge. In the fourth quarter of 2025 alone, WaterBridge handled a record 2.6 million barrels of produced water every single day. Now look, that's a number so big, it's actually kind of hard to wrap your head around it. So let me put that into perspective for you. That is enough water to fill over 150 Olympic-sized swimming pools every single day. This tells you right away this isn't some small-time operation running a few trucks around. Now, this is an industrial-scale circulatory system, a real testament to the massive, relentless demand for what they do, right in the heart of the Delaware Basin, which, as you know, is the most productive oil field in the entire country.
Okay, so all that volume is great, but the big question is, can they actually monetize it? Well, the answer is a resounding yes. That torrent of water translated directly into a record-breaking $208.9 million in revenue, just for the quarter. This number right here, it shows their ability to turn that massive physical flow into some serious cash flow. Now you might look at that and say, well, a 2% increase from the previous quarter, that doesn't sound like a huge leap. But in a business of this immense scale, consistent, positive growth, even if it seems small, is the sign of a steady, reliable, and frankly, an incredibly healthy revenue engine. This is all about stability and predictability right at the top of the income statement.
And this is where it gets really good. When you zoom out and you look at the full year picture, the growth story gets even more powerful. Their pro forma revenue, and look, that's just a fancy way of looking at all their different assets as if they were one unified company for the whole period. It shows a powerful 19% jump year over year. That is not a flash in the pan. It's not a one-quarter wonder. This is the kind of sustained, high-torque momentum that tells you the core business has incredibly strong demand. It's a clear, beautiful upward trajectory.
Now, what's really interesting about this slide is how it kind of tells two different stories. If you look at just the top two lines, everything looks great, right? Volumes are up, revenue is up, the core engine looks fantastic. But then your eyes start to drift down to those bottom lines. Adjusted EBITDA, which is a key measure of operational profit, it actually dipped a little bit. And more importantly, you see that number sitting there in parentheses, a net loss of $13.6 million. So how? How can a company with record revenue still be losing money? That's the right question to ask, and it means it's time to get out the tools and start looking for some cracks in the foundation.
You bet I am. That top-line revenue is beautiful, I'll give you that. But you know what they say, revenue is vanity, profit is sanity. It's absolutely fantastic that they can move a mind-boggling amount of water, but are they actually making any real hard money doing it? So let's just look past the shiny top line for a second. Let's look past the impressive volume numbers, and let's actually inspect the foundation of this company for some stress fractures. Because a structure with a weak foundation, well, no matter how impressive it looks from the outside, it is ultimately 100% of the time destined to crumble.
And here it is. Here is the first major crack. For all that record revenue in 2025, for all that impressive 19% growth you were just talking about, the company posted a pro forma net loss of over $58 million for the full year. Let's be crystal clear about what this means. This isn't some esoteric accounting quirk that we're digging up. This is the bottom line, GAAP number. That's generally accepted accounting principles. It's the official scorecard, the one that counts. So what are we celebrating here?
Are we celebrating a company that can generate nearly $800 million in sales? Or are we looking at a company that somehow managed to burn through all of that and then lose an additional $58 million on top of it?
This slide right here gets to the absolute core of the issue. This is the fork in the road. This is where the bull and the bear case is split into two completely different narratives. The company, and frankly anyone who's bullish on this stock, they want you to focus exclusively on that number on the left, adjusted EBITDA. And yeah, it's a big, healthy-looking number, over $400 million. But the reality, the official GAAP net loss, the number that actually matters, is sitting right there on the right. The gap between these two numbers is nearly $500 million. We have to understand what's hiding in that gap to understand the real health of this company.
Now hold on. Let's be fair here. Adjusted EBITDA is a standard metric in capital-intensive industries like this. You know that. They didn't just invent it out of thin air. The entire purpose of this number is to strip out the non-cash expenses, things like the depreciation of assets, and also financing costs, to give you a clean look at the raw cash-generating power of the physical infrastructure itself, the pipelines, the disposal wells, all the facilities. And for an infrastructure investment, that core operational profitability is exactly what you want to see. It tells you that the basic business model works before you start accounting for how it was financed.
But the crucial point is what it excludes. That's not a defense, it's practically a confession. These aren't some minor adjustments on the margins. It's ignoring nearly $140 million in very real interest payments that have to be sent to lenders. It's ignoring over $250 million in depreciation, which is the very real tangible cost of your assets getting older and wearing out. You can't just wish away the cost of your debt and the physical decay of your infrastructure. This isn't an adjustment, it's a fantasy. It's a number that just pretends some of their biggest real-world costs simply don't exist.
And speaking of debt and interest payments, well, that brings us to the single biggest load-bearing wall in this entire structure. That $140 million interest expense we just saw, that isn't just a number on a page. It's the crushing real-world weight of the debt they've taken on to build this empire. The question now becomes, can that financial wall handle the immense pressure it's under, or is it about to buckle?
Just look at this chart. This is a staggering, almost breathtaking increase in leverage. The company's total borrowings more than doubled in a single year, exploding from about $600 million to nearly $1.5 billion. That is a mountain of debt they've taken on to fund all these acquisitions and their massive building projects. And this, fundamentally, changes the company's entire risk profile. Every single dollar of that new debt adds to the constant, grinding pressure of interest payments they have to make, month after month, quarter after quarter, no excuses.
And hey, don't just take my word for it. This independent analysis from Guru Focus flags a critical warning sign. Now, the interest coverage ratio, it's a really simple stress test. It tells you if your operating income is enough to cover your interest payments. It's that simple. A healthy company, they want a ratio well above 1.5, which means they have plenty of cushion. WaterBridge's ratio is 0.36. Let me repeat that, 0.36. That means for every single dollar they owe in interest, they are only generating 36 cents in earnings to pay for it. That is not a sustainable model. That is a fundamental, dangerous crack in their financial foundation.
See, this is exactly where you're missing the bigger picture. You're looking at that debt as a pure liability. And okay, it is, but you're completely ignoring the asset side of the equation. That debt wasn't used for parties and corporate jets. It's the steel and the concrete they are using to build the future of this company. It is a strategic investment, plain and simple. Let's move on to their 2026 blueprint so you can see exactly what they're building with all that capital.
Look, these are not speculative ventures, all right? These are large-scale, high-return projects, and they are backed by what are called minimum volume commitments, or MVCs. You need to think of these like long-term, take-or-pay contracts that literally guarantee a certain amount of business from major players like BPX and Devon Energy. What that does is it provides a steady, a predictable, and a contractually obligated revenue stream for years, sometimes for decades to come. They're spending heavily now to build the infrastructure that is going to generate the cash flow to pay off that debt and then reward shareholders for years into the future.
And look, their own projections show exactly what this build-out is designed to deliver. Their 2026 guidance shows that adjusted EBITDA, that core operational cash flow we talked about, is expected to grow to as much as $460 million. This is the growth they're counting on. This is the payoff that's supposed to start chipping away at that mountain of debt and finally prove that their high-leverage strategy is actually working. This is the plan.
But can they afford the plan? Your own slide shows the massive problem here. Just look at the numbers. Their projected capital expenditures for 2026 are somewhere between $430 million and $490 million.
In a best case, everything goes right scenario, their adjusted EBITDA is $460 million. Do you see the problem? This means they are projecting to spend every single dollar of operating cash flow they bring in, and potentially millions more, just on building new projects. This isn't paying down debt, this is doubling down on the bet. So where is the free cash flow for shareholders? Where's the money to pay down that $1.5 billion in debt? They are on a capital expenditure treadmill, and they are running faster and faster just to stay in the exact same place.
All right, we've laid out the raw materials, we've looked at the blueprints, and we've stress-tested all the key structural supports. So now it is time for the iron verdict. Let's put the bull and the bear case side by side one last time and see how this entire structure holds up under the combined weight of its ambitions and, of course, its obligations. Okay, the bull case is built on a foundation of powerful, absolutely undeniable growth in revenue and volumes. This is a real high-demand business. There's no questioning that. They have incredibly strong operating margins, with an adjusted EBITDA margin that is consistently over 50%, which is honestly top tier. And they have a clear path to future growth that's already locked in with those long-term fixed-fee contracts. They've even started paying a small dividend, which is a really bold move that shows you management's confidence in their future cash flow. The bear case, however, points to deep, undeniable cracks in that very same foundation. They have consistent, real-world net losses. They have a massive and a rapidly growing debt load that results in a dangerously low interest coverage ratio, which should be flashing bright red on any risk screen. And the business model, as it stands right now, is burning through every single dollar of cash it generates just to fund its own growth, leaving almost nothing on the table for shareholders or, more importantly, to pay down their massive debt.
So ultimately, this is not a stock for the faint of heart. It is not a boring utility company you can just buy and forget about. You really should view it as a high-stakes construction project. If you invest, you are betting that this company can execute perfectly on its massive growth plans, bring them online on time and on budget, and that the resulting cash flow will be enough to outgrow its enormous pile of debt before that debt crushes the entire structure. The potential reward here is significant, but you have to understand it is tied directly and inextricably to that immense risk.
So the final question really is for you. After seeing the numbers, the growth plan, and all the significant risks, what do you see? Do you see a fortress being built that will dominate this niche for a decade to come? Or do you see a financial trap being set, baited with impressive top-line growth but built on a foundation of truly unsustainable debt? The answer to that question is what will determine if this is a stock you're willing to bet on. That's our stress test. This is Iron Financial, helping you cut through the weakness to forge a stronger portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.